When economies shrink, debt should shrink with them. That's what logic tells us. Less growth, less income, less borrowing. And yet history shows the opposite. During recessions, debt explodes. During crises, borrowing accelerates. During collapses, liabilities multiply. Here's the mystery. How can debt grow faster precisely when economies are failing? And more importantly, who benefits from a system that expands obligations during contraction? Because this isn't a bug, it's not a mistake, and it's not accidental. It's a machine, quiet, technical, and largely invisible dies to keep expanding even when the real economy is shrinking. Today, we're uncovering how the global debt machine works, where it came from, why it survives every crisis, and why each economic downturn makes it stronger, not weaker. Section 1. Setting the stage. The contradiction at the heart of modern finance. Most people think debt works like this. You borrow when times are good, you pay back when times are bad. And when economies shrink, borrowing slows. That may be true for households, but it is not true for systems. Modern economies are not driven by savings, they're driven by credit. And once credit becomes the engine of growth, shrinking the economy becomes dangerous because debt doesn't disappear just because income does. This contradiction sits at the heart of modern finance, a system that requires expansion but creates permanent obligations. To understand how this paradox formed, we have to go back to the origins of modern debt. Section 2. Origins. When debt stopped being temporary in early economies, debt was personal and finite. You borrowed grain. You borrowed tools. If the economy contracted, debts were forgiven, restructured, or defaulted. You borrowed money backed by something tangible. But as banking systems grew, something changed. Banks discovered they didn't need to lend existing money. They could create it. Through fractional reserve banking, loans became money, and money became debt. Every new loan expanded the money supply. Every repayment contracted it. This meant economic growth became dependent on expanding debt. Households borrowed to maintain living standards. By the 19th century, entire national economies relied on continuous borrowing to function. Debt was no longer temporary. It became structural. And once governments adopted this model, there was no going back. Section 3. The rise. How debt became the engine of growth. The 20th century transformed debt from a tool into a foundation. Wars accelerated borrowing. Reconstruction normalized deficits. Central banks institutionalized credit expansion. After World War II, global systems were built around one assumption. Debt-fueled growth is normal and necessary. Governments borrowed to stimulate economies. Corporations borrowed to expand markets. As long as economies grew faster than debt, the system looked stable. But there was a hidden flaw. Debt compounds. Growth does not. And over time, debt always wins. Section 4. The breaking point. When growth couldn't keep up by the late 20th century, something became clear. Productivity slowed. Wages stagnated. Real economic growth weakened. But debt didn't slow down. Instead, it accelerated. To maintain growth, systems responded with lower interest rates, easier credit, financial innovation, asset bubbles. Debt expanded faster to compensate for slower growth. This worked temporarily, till it didn't. The result was predictable. Asset bubbles burst, economies contracted, and suddenly, incomes fell but debts remained. This is where the debt machine revealed its true design. Section 5. The fallout. Why debt expands during collapse when economies shrink. 3 things happen simultaneously. 1. Revenues collapse, tax income falls, corporate profits drop, household earnings shrink. 2. Obligations remain, debt payments don't pause, interest doesn't stop, contracts stay enforceable. 3. Systems intervene to prevent default cascades. Authorities step in. Governments borrow to stabilize economies. Central banks inject liquidity. Institutions refinance liabilities. New debt is issued to service old debt. This is the core of the machine. Debt expands to prevent debt from collapsing. And because collapse is politically and financially unacceptable, expansion becomes the only option. Even when the economy shrinks, especially when it shrinks. Section 6. Failed fixes. Why deleveraging never lasts after every crisis. Same promises made. We'll reduce debt. We'll return to fiscal discipline. We've learned our lesson, and briefly debt slows. But the system can't tolerate contraction, because reducing debt also reduces money supply, which reduces spending, which causes recession, which triggers more borrowing. Every attempt to deleverage ends the same way. Austerity causes instability. Instability demands stimulus. Stimulus requires borrowing. The machine restarts. Debt levels rise higher than before. This isn't policy failure. Structural inevitability. Section 7. Modern parallels. The machine today. Today the scale is unprecedented. Global debt exceeds $315 trillion, more than 3 times global GDP. During the 2008 crisis, debt surged. During the 2020 shutdowns, it exploded. During rate hikes, it didn't disappear, shifted. Governments borrow more, corporations refinance, households stretch credit. Even as real economies struggle, the debt machine grows. Why? Because collapse is no longer allowed. The system has been trained to survive at all costs, even if survival means permanent expansion. Section 8. The repeating pattern. Every cycle follows the same logic. Growth slows, debt fills the gap, debt outpaces income. Crisis erupts more, debt is issued to stabilize the system. Total obligations increase. Each cycle raises the baseline. Each recovery starts with more debt than the last. This is why economies feel weaker even during recoveries. They are carrying more weight. 3 takeaways. 1. Debt no longer responds to the economy, dominates it. Growth adjusts to debt, not the other way around. 2. Crises are fuel for the debt machine. Instability justifies expansion. 3. Shrinking the economy does not shrink obligations, strengthens the system that manages them. Final warning, a system that can only survive by expanding debt during contraction is not fragile, it's dependent. And dependence creates limits. Not today, not tomorrow, but eventually. The question isn't whether the debt machine will stop. It's what happens when expansion no longer works. Call to action if you want to understand how modern financial systems really operate and why debt keeps growing no matter what. Like, subscribe, and turn on notifications, because the machine doesn't sleep. And now that you've seen it, you can't unsee it.